Bootstrapping is like cooking a meal using only the ingredients you already have in your pantry. You rely on personal savings, revenue from early customers, or even credit cards to fund the business. Venture capital VC fundraising, on the other hand, is akin to asking a wealthy friend to buy a share of your restaurant in exchange for cash that can buy premium ingredients and a bigger kitchen. The core distinction lies in source of capital, self-funded versus external investors, and trade-off maintaining full control but growing slowly versus giving up ownership for rapid scaling. Bootstrapped firms often iterate slowly, test hypotheses on a tight budget, and keep decision-making simple. VC-backed firms receive large cash infusions, professional network support, and a pressure to hit high-growth milestones, but they must answer to investors and meet formal milestones, for example, quarterly KPIs. Both paths serve different risk tolerances, market dynamics, and founder goals. Equity dilution measures how many of those new slices go to the investors. If a founder owns 100% of a $1 million pre-money valuation company and sells $250,000 of shares, the post-money valuation becomes $1.25 million, and the founder's ownership falls to 80%. 100% times $1 million divided by $1.25 million. This reduction in ownership can affect control. Many VC deals include voting rights, board seats, and protective provisions that allow investors to block major decisions. Bootstrapped founders retain 100% ownership and therefore full strategic control, but they may lack the capital to pursue large opportunities that could increase the firm's value. The trade-off is between control, bootstrapped, and resources for growth, VC-backed. Early-stage valuation is not an exact science. It is more an art informed by comparable data and future potential. The two most common numbers are pre-money valuation, the company's worth before new money arrives, and post-money valuation, worth after the investment. The relationship is post-money equals pre-money plus investment. Ownership percent for investor equals investment divided by post-money. For example, if a startup is valued at $4 million pre-money and raises $1 million, the post-money valuation is $5 million, and the investor receives 20% ownership. Comparable metrics include revenue multiple, user base multiple, and industry-specific benchmarks. For example, SaaS firms often use a 10 times ARR multiple. Using these, founders can triangulate a reasonable pre-money range before negotiations. A common shortcut is the Berkus method, which assigns up to $500,000 for each of 5 risk reduction categories: sound idea, prototype, quality management team, strategic relationships, product rollout, helping bootstrapped founders to estimate a realistic valuation without formal market comparables. Runway months equals cash balance divided by monthly burn. Bootstrap scenario. Assume a founder starts with $150,000 of personal savings, monthly burn of $15,000, office, salaries, cloud services. Runway equals $150,000 divided by $15,000 equals 10 months. No external pressure. The founder can extend runway by cutting costs or generating $5,000 per month of revenue, reducing net burn to $10,000 and extending runway to 15 months. VC scenario. The same startup raises $1 million Series A at a $4 million pre-money valuation. After the raise, cash equals $1 million, ignoring existing cash. If the VC-backed growth plan increases monthly burn to $70,000, new hires, marketing, runway equals $1 million divided by $70,000, approximately 14 months. The higher burn is justified because the company expects to close a Series B in 12 to 15 months at a higher valuation. Financial models typically include a burn chart showing cumulative cash outflow, a sensitivity table how runway changes with different burn rates, and a funding gap analysis that flags when additional capital will be needed. The cost of capital for bootstrapping is largely an implicit opportunity cost. The founder's time, personal savings, and the foregone return on that money if it were invested elsewhere. For example, a stock market return of 7 to 8% per year. If a founder invests $200,000 of personal wealth and could have earned 8% annually, the implicit cost is $16,000 per year. VC investors demand an explicit return, often expressed as a target IRR of 30 to 40% for early-stage funds. Using the same $1 million investment at a 35% IRR, the investor expects the company to be worth roughly $3.5 million after 3 years. Future value equals 1 million multiplied by 1.35 cubed, approximately 2.5 million, plus additional cash outrights. Bootstrapped cost approximately 8%, opportunity cost of personal capital. VC cost approximately 35%, required IRR. Founders must decide whether the higher capital infusion and accelerated growth potential outweigh the higher ownership cost, implied by the VC's required return. When a VC signs a term sheet, they negotiate a set of rights that shape corporate governance. Key provisions include board composition. VC may require a seat on a 3-member board, turning a founder-only board into a shared decision body. Protective clauses. Veto rights on actions like issuing new shares, changing the dividend policy, or selling the company. Liquidation preference. Often a one-time non-participating preference, meaning the investor gets their invested capital back before any proceeds go to founders. Anti-dilution. Weighted average protection reduces founder ownership if a later round is priced lower. Bootstrapped companies face no such external governance constraints. The founder can decide everything, though they may still adopt advisory boards or informal mentors. The trade-off is that VC-backed firms gain professional oversight, which can improve discipline but also slow decision-making. The exit route determines the final return on investment, ROI, for founders and investors. Acquisition. A venture capital-backed firm may be bought for a multiple of revenue or earnings, for example, 5 times EBITDA. If the exit value is $50 million and the venture capital owns 30% after dilution, the venture capital receives $15 million, which is 30% of $50 million. The founder's remaining 70% yields $35 million, but the founder's original ownership may have been far less due to earlier dilution. IPO. Public markets can value a high-growth firm at lofty multiples. Venture capital investors often sell part of their stake during the initial public offering, locking in returns, while founders may retain a larger share if they protected their equity. Secondary market. In later rounds, early investors can sell shares to new investors, providing liquidity without a full exit. Bootstrapped firms often exit via acquisition at a modest multiple, because they have grown organically and may lack the scale to IPO. However, the founders keep a larger share of the proceeds because they did not dilute heavily. The return on investment for a bootstrapped founder can be extremely high. For example, 10 times personal investment, even if the total exit value is lower than a venture capital-backed IPO. Explanation. Sample exam-style questions. 1. Dilution calculation. A startup has a pre-money valuation of $4 million. It raises $1 million from a venture capital. What is the post-money valuation and the founder's ownership percentage after the round? Answer. Post-money equals $4 million plus $1 million equals $5 million. Investor ownership equals $1 million divided by $5 million equals 20%. Founder ownership equals 80%. 2. Funding decision. A founder has $120,000 of personal cash and expects a monthly burn of $12,000. Without external funding, how many months of runway does the company have? If the founder can raise $800,000 venture capital round, increasing burn to $70,000 per month, how many months of runway does the VC-funded scenario provide? Answer. Bootstrapped runway equals $120,000 divided by $12,000 equals 10 months. VC runway equals $800,000 divided by $70,000, approximately 11.4 months. 3. Cost of capital comparison. Assume the founder's personal funds could earn 8% annually. What is the implicit annual cost of using $200,000 of personal money for 3 years? Compare this to a venture capital's required internal rate of return of 35% on a $1 million investment over the same period. Answer: implicit cost equals $200,000 times 0.08 times 3, approximately $48,000, or about 8% per year. Venture capital expected future value equals $1 million times 1.35 raised to the third power, approximately $2.46 million, implying a required profit of $1.46 million, far higher than the implicit cost. 4. Governance impact. List 3 protective clauses a venture capital might request and explain how each could limit a founder's ability to make unilateral decisions. Answer: first, board seat gives venture capital voting power on major decisions. Second, liquidation preference ensures venture capital gets invested capital back before founders in a sale. Third, anti-dilution adjusts founder ownership if later rounds are cheaper, preventing further dilution. 5. Exit ROI calculation. In an acquisition worth $40 million, a venture capital holds 25% after dilution, and a founder retains 50%, the rest is held by employees. How much does each receive? If the founder originally invested $100,000 and the venture capital invested $2 million, calculate each party's multiple on invested capital. Answer: venture capital receives $10 million, 25% of $40 million, multiple equals $10 million divided by $2 million equals 5 times. Founder receives $20 million, 50% of $40 million, multiple equals $20 million divided by $100,000 equals 200 times. These problems test a student's ability to translate financial concepts into quantitative analysis and to weigh strategic trade-offs between bootstrapping and venture capital financing.